Lothar Mentel is Chief Investment Officer at Octopus Investments, and he said ring fencing could actually worsen the crisis in the financial system. Really?
Morning.
Really? Would this really make things so much worse?
It deals with the aftermath of a crisis, but it doesn't prevent it. The crisis came about because of a structured credit market that wasn't really regulated and supervised. This doesn't change this in any way or form. And indeed, if the refinancing for the banks becomes more expensive through this ring fencing, there's a big incentive to use the structured credit markets even more again in the future. At the moment, they're taboo. They're not being used very much. But hey, you know, if your profitability depends on getting cheap funding, then they may be very much trying to get all those loans off their balance sheets again in the future.
Do you agree with the Institute of International Finance, who came out with their report over the weekend, that this actually could cost around 7 million new jobs and it could really hit GDP by 2015 by more than 3%?
Not necessarily. It's far in the future. We've just said 8 years. You know, a lot of things can happen in 8 years.
Can you imagine what the world is going to be like in 8 years' time?
Bankers are quite inventive when it comes to go around and make things work for them. So I doubt it will have that big an impact, that big a cost. What I'm more worried about is it's not actually addressing the core problem, which is the structured credit market.
Well, I was going to ask you a bit more about what the core problem is and how we can actually deal with that, and why perhaps these sort of banking new regulations coming out are not dealing with what you think is the main problem.
Well, the way you can deal with the structured credit market is just by giving it a regulatory framework, not rely on the markets, because the markets can only do their job if there's transparency, if there's we as analysts can analyze those CDOs that come out, and at the moment, or particularly in the past, we couldn't, because there wasn't a generic structure like with corporate bonds. So get a generic structure in, put some supervision in, and then it will be a much safer market. As with regards to the banks, to my mind, if those are some banks too big to fail, and it's certainly a problem in the UK, then rather than applying a 1930s solution, try to think of the complexity of the 21st century and put some better supervision in place which deals with those problems. Is
it too complex, very briefly, for the regulators to get their heads around, really? I mean, stick your neck out.
I wouldn't want to comment.
Thanks, sir. Very good to talk to you. Thank you very much.
Thank you very much.